Hello students, welcome to Kavita's classroom. I hope you are liking, sharing and subscribing my videos. So let's begin today's session. And we had been talking about the government budget in our previous videos, and the topic in hand today is the government deficits. First and foremost thing, what do you mean by the term deficit? Deficit means when there is some shortage, right? Let's talk about my example. Then I'll switch to the government. So to make it very clear, I'm just trying to do this way. Whenever I'm talking about revenue deficit, it means my routine incomes and routine expenses are not matching each other and the expenses are more than the income. For example, if I'm earning say 1 lakh rupees and my expenses are say 1 lakh 20,000, and expenses means I'm talking about the electricity, phone bills, food items, right? Clothing, education of my kids. And these things means it has no component of asset or liability in it. My routine income and routine outflows, routine recurring expenses, when are mismatched, this gives rise to a situation of a revenue deficit. And the same happens with the government also. So when government's operating expenses are not met with its routine recurring incomes, it gives rise to a situation of revenue deficit. And what's the formula? The formula is total revenue expenditure minus total revenue receipts. We have already had this discussion in our previous class. The receipts, revenue receipts can be the tax and non-tax receipts. And the revenue expenditures can be the salaries and wages of the government department, the other expenses, routine expenses, right? The consumable expenses, etc. So what's the significance? The moment we get to have this, that government is suffering a revenue deficit, it means there is some problem. The normal operating expenses are not getting matched with the incomes. It means government is dis-saving. What do you mean by the term dis-saving? Because it has to carry on, right? So it's meeting its expenses through some other previous savings or borrowing, right? So the implication is when the expenditure is more than the receipt, so the borrowings happen and this may lead to the debt. Debt means it may have the future interest payment liabilities and hence it may start becoming a spiral. It means debt trap can be a potential situation in this case. Now the second is the fiscal deficit. And when I say the fiscal deficit, this is the most important because it gives you an overall picture. As revenue talks about only one side, right? The routine expenses and incomes, but fiscal deficit gives you the comprehensive picture. Let me give you some example for an individual, then we'll switch to the government. For example, if I'm talking about a person X, right? The person X income is say 1 lakh, right? And he in routine spends the routine expenses or the revenue expenditure. This would be a revenue receipt, right? So say he spends every time 70,000 and is able to save 30,000. So the first point is the person having any revenue deficit? No, the person is all saved 30,000 is his saving, right, every month. Now, when we talk about the comprehensive picture, he does have the FDs in his account of say 5 lakhs and he has a piece of property, some land holdings, right? So property worth rupees say 10 lakhs. Right. And now, in this month, he wants to buy another asset by selling off this property. And he wants to just make it a bit bigger. Right. So he wants to have 18 lakhs of worth of property now. So this is going to be his expenditure. Right. So is he able to meet this expenditure from whatever he has? So the capital expenditure would be this, right? and the capital receipts are these FD and property, and the revenue receipt is this and revenue expenditure is this. So what is his net situation? Is he in a position to go ahead with this property purchase with the against the property sale which he has earlier? Now we have to check. He has already 15 lakhs with him and 30,000 also are saved. So 15 lakhs and 30,000 are there with him and he wants to buy something worth 18 lakh. So what is he stuck at? He needs 2 lakhs and 70,000 more. That is, he has to borrow. And if he borrows, he is matched with all his expenses and incomes. But till he doesn't borrow, he is stuck at this figure, and this is called the fiscal deficit. Now, please try and understand, when we are talking about the fiscal deficit, we are taking capital as well as the revenue things, right? The inflows as well as the outflows. So when the government talks about its all routine expenses and incomes and the assets and liabilities also, and one net clear picture is the fiscal deficit. Where is it? And how much is still the requirement of the government, which is not matched with its previous assets and liabilities as well. So the formula is fiscal deficit is total budget expenses and total budget receipts are seen here, excluding borrowings. Why do we say excluding borrowings? Because if we are stuck at this figure of 2 lakhs and 70,000. So if we borrow this, we do not have any deficit at that moment. But till we are not having this amount, we are struggling with the deficit. That's why we say the borrowings which we need is nothing but the fiscal deficit. So what would be the other formula? Instead of writing total budget expenditure, we'll say the revenue expenditure plus capital expenditure here and minus, again, total would be the revenue receipts as well as the capital receipts other than the borrowings. So this formula can be broken further. Why is it being talked about? Because that gives a complete picture of somebody's government's operations altogether. Right. So when we talk about the significance, the most important measure it is because it represents the total borrowing requirement of the government. Total borrowing means whether it borrows from the local market, external market, RBI, whomsoever. The borrowings are needed to this tune. So it indicates that extent to which the government is spending beyond its non-debt creating means, right? So financing has to be done through borrowings. So the implications are severe. How severe? Because when we are borrowing, it means instead it's not only the principal amount to be paid, we need to service that debt with the help of interest also. So the debt keeps on compounding and hence we are in debt trap. At times, government tries to fulfill this need by printing new currency. So new currency when is done? So this is called deficit financing. But because that increases the money supply in the economy, this gives rise to inflation as well. Now, what is the other consequence? The other consequence is the crowding out. So what is crowding out? Crowding out is when government is in need of money and the whole money of the economy, a major chunk of money is taken up by the government from the public or RBI or some external sources, and the private investors are left with no money or less than required money. Because of this, the interest rates go higher and the private investors do not have enough amount of money for them as it becomes expensive. So this crowding out also is a major impact of fiscal deficit. Then we talk about the future burden. Of course, if we are borrowing, we are adding on our burden for future because we are already engaging our receipts against those liabilities. And then the foreign dependence, if we are helping ourselves with external loans, it means they would poke their nose in our internal affairs, and hence we may have some foreign dependence as well as the intervention by them, right? And then the third and the last type of deficit is the primary deficit. Now, what does it indicate? It says it talks about the ongoing year particularly. That is government excluding the interest which was taken up on the previous borrowing. Just for this part, just leave this. Is government managing the ongoing year well or not? Right. So it means fiscal deficit minus interest payments. It shows the borrowing requirement of the government, excluding the interest payments on the past debts. It simply reflects the current fiscal imbalances. Right. So the implication is a zero primary deficit means government needs to borrow only to cover the past interest, not for the current expenses. Now, let me explain this with the help of this formula only. The primary deficit is equal to fiscal deficit minus interest payments. Now, you try to assume a case where there is no interest to be paid for any past borrowings. It means if there is, then what does this equation become? This equation says that if there is any fiscal deficit, that is on account of the current imbalances of the government. Previous impact, previous loans are not creating or adding on any fiscal deficit. Right. Now, what do we have if I'm taking another example? If there is no primary deficit, I'm saying case one is this, and let's talk about case two, where we have no primary deficit. No primary deficit means fiscal deficit minus interest payments are zero. And what does it mean? It means the fiscal deficit is nothing but the interest payments. Now, what does it mean? That if the government is having any sort of fiscal deficit in this very year, it's not on account of the current operations. This year's receipts and payments are matched. It's only for the interest which has to be paid on the previous obligations. We are facing the deficit on this ongoing year, right? So with this, we end up with the whole fiscal, the deficit parts, the revenue deficit, the fiscal deficit, as well as the primary deficit. Now let's talk about the fiscal policy. What comes to your mind when I say fiscal policy? Fiscal policy simply talks about how the government is spending and how the government is earning. So all the policy components are the government expenditure policy, where it all spends on the welfare schemes or infrastructure policies or projects. Then the taxation policy. Taxation policy talks about the inflows of the government. The third component is public debt policy. This simply talks about if the government tries to manage its borrowings through the public debts. And then deficit financing means managing the borrowings by printing some new notes, and the currency is increased in the economy, the money supply is increased, and hence it can lead to inflation. When we talk about government debts, debts means bad because general concept is debts would lead to the burden on the economy, but you must keep a note of it that if the debts of the government are for strengthening the infrastructure, then these are not always taken to be bad. If the debts are taken by the government for routine expenses, that talks about the inefficiency of the government. High levels of public debt can lead to the concerns of sustainability, potential downgrades by the credit rating agencies, and increased interest payment burdens, limiting the government's fiscal space for developmental expenditure. I hope the topic is clear to you. Your comments are always welcome. See ya. Bye-bye.